Hi, everyone, and welcome to this session. I just want to see a quick show of hands. Who here is currently raising money for an XR startup or planning on doing so in the near future? Wow. All right, you're in the right place. We'll definitely leave about 10 minutes for Q&A so you can get your direct questions answered. As was mentioned, I'm Carter Rogers. I'm at Superdata. We're a market research firm that specializes in interactive media, which includes digital games, as well as related media like AR and VR, esports, and live streaming on sites like Twitch. And let's set the stage. Last year, XR startups raised about $1.8 billion. That is not including Magic Leap, which has raised over $2 billion life to date from everyone from Saudi Arabia's Public Investment Fund to Alibaba to Google. It's a rosy picture if you look at this company, but on the other hand, last year we also saw immersive tech startups like Cast AR shut down due to a lack of continued funding. So as you can see, there's quite a spectrum of success when it comes to raising money as an AR, VR, or MR startup. And we've assembled a great panel to discuss how you all can most effectively raise those funds. First off, closest to me, we've got Prashant Matta at OMERS Ventures, one of Canada's largest venture capital funds. He's responsible for investing in technology companies across sectors like AR and VR, blockchain, and enterprise software. We've also got Abby Albright, co-founder of the WXR Fund, a seed stage fund focused on investing in women-led startups in the immersive tech space. Abby was previously a fellow focused on the AR and VR ecosystem at Mucker Capital. We've also got Jacob Loewenstein, who drives business development and product strategy at Samsung Next, which is Samsung's software and services innovation arm. He also co-founded VR and AR at MIT, which is dedicated to fostering XR innovation. Amy LaMeyer is an angel investor in XR startups and founder of EnteringVR.net, which provides resources for learning about the XR industry. She's also a mentor for the XR accelerator programs, including Boost VC and the Women in XR Venture Fund. And finally, we've got Teppei Tsutsui, who's the CEO and managing director of the GFR Fund, which is a seed stage fund of $18 million that invests in VR and AR companies primarily in North America, and previously led several key investments and acquisitions in Tokyo, including GREE's acquisitions of OpenFate and Funzio. And to kick things off, I think it's important to note that, as we all probably know, the virtual reality has had a relatively slow consumer uptake compared to what a lot of people initially projected. And I want to hear from our panelists about how that uptake has affected both how VR startups raise funds and how AR or MR companies will raise funds. How do investors view that? What are they going to look for going forward?
Hi, everyone. So firstly, thank you, Carter, for putting together an amazing panel. Can we get a little round for Carter? I know we usually end, but to start.
You're very welcome.
Thank you. Okay, so the good news is, here's a nice update. Samsung Next still believes in both VR and AR. Okay, breathe in, breathe out. We think both technologies are going to be very important and are going to shape how people consume information moving forward. The real question for us always boils down to timing. And I think I want to put AR aside for a second because I think VR is where I've seen a lot of people lose wind in their sails over the last year. And a lot of people come and ask the question, they say, does anyone even care anymore? Is there any point in pitching a VR company to a venture fund? It's worth it to note that Samsung often looks from a strategic perspective, right? Like Samsung Next is a strategic investor. So for us, because we believe in VR, the answer is resoundingly yes. We still want to look at these investments. But to wrap myself up, I think the important thing to think about is if we're going to look at you as a company, if we're going to look at you as a scalable enterprise, why do we believe that you're going to stick around and survive and grow with this industry? And so the one piece of advice I would give right now, and that I would just say is, ask yourself the question of, well, why should they believe that I'm really going to scale? If I'm a core tech company, is this a piece of core tech that's going to grow with the growth of the ecosystem? If I'm a content company, am I going to be able to hang around until the inflection point? Those are usually how these conversations tend to boil down. And it's often the structure of the conversations I have when folks come and present VR companies to me.
Yeah, I'd add on that. I think that especially given so much of this has to do with, in both VR and AR, it seems to be leaning towards enterprise, then the question is, can you survive from a services standpoint before, the platform is profitable from a subscription model standpoint? So I think there's still an expectation from a lot of the startups that we see that just having a few services contracts here or there is enough to get them funding, and I think that that's not necessarily the case, because we still think it's going to be quite a bit of time before it's truly at scale, and so as an industry, and so really needing to see better numbers than I think a lot of people think they have to present. Is what I would say.
Yeah, I can just add to that. Hi, everyone, Prashant. We have generally focused top of the stack. In VR specifically, we've made one investment focused on content, because our view was in the short term, the value will get captured there as a lot of the platforms start to build ecosystems around their either device or ecosystem of applications around them. What we see bottom of the stack is very crowded and difficult to scale, especially if you're in hardware, and hence a lot of the hardware plays have been kind of waved out, and I would say most investors stay away from them. Interesting opportunities, middle stack, to Jacob's point, core tech, if you're building core tech, which would help drive, either improve existing devices out in the market or just delivery of different experiences, that is interesting. And from our perspective, we do believe we'll see more and more content applications, specifically in VR, come up as you start to see more mobile devices such as Oculus Go that are probably going to drive a lot more consumer adoption in the future.
All right. Follow-up to that, I guess, is when we think about what types of startups are going to have the easiest or hardest times raising funds, regardless of AR or VR, whether you think consumer or enterprise will have an easier time raising funds at this point.
So I think, whether it's AR or VR is obviously a question of what the use case is, and if, VR is needed for something that's an immersive experience that doesn't exist, where obviously AR is, layered on top of reality. So, from that instance, it just depends on the use case. But for anybody that happened to listen to Tim Merrill at DigiCapital earlier, I mean, that's the key right there, is are you solving a problem or doing something that hasn't been done before?
So I guess to us, the most important thing for the company to look at is more like the founders and the market fit. So it's all not depends on which way that you want to go, which things or which product you want to develop. It's more like the what you have done before, and that's what's combines your expertise and experiences, and what you want to do is more aligned with what you have been doing. So that's as an investor, we look at more, what you can do with your team and also your experiences. So it's more just not the to start the things that the investor would be interested in, more like what's you're coming from, what's what you really want to do, and just leveraging your expertise might be a really good way to talk to the investors.
And regarding, go ahead.
I think I've noticed that a lot of tropes tend to get repeated. I think there are a lot of conferences in the VR AR space, and I kind of start to hear some things repeated. And I don't mean to attack the hypo, but part of me feels like the question of enterprise versus consumer is the wrong question. Because I've heard panels where people are don't worry about consumers, go focus on enterprise. And then if you think for more than 30 seconds about it, you'll get to the point and be oh wow, enterprise sales are really hard. Often these spaces are really fragmented. Do I really have the personnel on staff to go and win this battle? And then you say, okay, actually, you know what, you're right. Enterprise is really hard. I'm going to go focus on consumer. And you say, okay, well, if I'm going to focus on consumer, is the user base with the hardware necessary to actually consume these experiences extant? Have I validated actual utility or entertainment value in what I'm creating? And then have I distinguished myself against a competitor? And then you probably round it out by saying oh, wow, both are really hard. But to echo some of the comments here, if you actually do the research, figure out product market fit, it's doable in both circumstances, but there's nothing structurally, in my opinion, more advantageous about going one route versus another.
Okay. Following up on that, are there certain areas you think are sort of overstuffed with companies right now, or certain areas where you feel are hot and very underserved based on the number of companies in the space?
I'm going to jump back in.
All right.
I think it's fascinating how many content companies are starting to develop tool platforms. I'm not saying it's a bad thing to do. I just find it quite interesting. And so now we've got these massive amounts of tools, which obviously are needed to create more content because we need content so that people can consume it. But I think that's a really interesting space that's a little bit harder for me personally to dig through and see where the value really is. But that shift from content creators to tool creators or platform creators is really an interesting space right now.
All right.
I just want to add that I guess I'm kind of skewed to more consumer side because our fund is like affiliated with the gaming company. So I personally like the more consumer stuff. But what I like to see more is the more like AR, social AR app, or more, I would say like a consumer AR app. It can be like a social, can be like anything, advertisement, or any like things that you can just interact with the people, like the friends around you. So that's like more like a personal preference that I will really love to see more consumer app.
I've talked to a lot of tool companies, and I echo your sentiment that there's like an interesting, I don't know if like someone passed a piece of advice on one time and it kept getting on where like a lot of content companies were having a hard time raising money, and so someone said, you should be a product company, and then they all kind of followed suit. But the problem is like if the core of your offering isn't like well differentiated and defensible, it's like in no circumstance, unless you've really thought this out, will it appear to be so. And I think in the tool side in particular, you need to ask yourself, like, when someone uses this, so why are they being drawn to use it in the first place? So you have to assume that the demand for the content that this facilitates creation of is going to grow, which I think a lot of people here like almost as dogma assume. I do too, that's why I'm here at an AR/VR conference. But then secondly, you have to ask yourself, well, okay, so why this tool? And I think a lot of the times tool sets boil down to some combination of this tool is easier to use, this tool uses a language that more people have like faculty for or something like that. But I think that those types of value propositions are at least flimsy on the surface, and so if you really are the easiest to use solution, then from a VC perspective, we need some sort of measure, some sort of like credible measure of the veracity of that. So if you're not coming to us with not only with dev signups, but then like maintained traction, meaning they signed up and they're using it, there's nothing to suggest other than anecdotal evidence that you've actually built something that's really useful and going to change the game. And so like by all means, like there is no tool company that recently I can think of that's like gone on and killed it. There probably will be one, but recognize that they're all being looked at with the same criteria in mind. And if you can't check those boxes, you're not going to have more success as a tool company than you did as a content company.
Now, to follow up on the question of, is this tool actually useful? I guess another question to sort of get into the nitty-gritty of fundraising would be, what are the other questions that, as a startup in the space, you need to be able to answer an investor if you're, giving a pitch?
I think focus is important, and just adding on to the comments around building tools. I think if you look at AR and specifically the state of mobile AR, it's gotten crowded, and it is very hard to differentiate, even though the good thing is there's an immediate distribution because there are mobile phones out there. But on the other side, you've got a whole bunch of existing companies that you'll compete with, and then a new crop of AR companies that are going after mobile. So it really comes down to focus and what specific segments the team has the expertise to build a product. If you start to look at more core foundational technologies, a lot of them have yet to be played out because devices like Magic Leap or other players that are building these AR devices that will eventually come to market, hopefully. So those types of startups and companies will have to play the waiting game a little bit until they're able to somehow demonstrate that their core technology or foundational pieces or elements are actually valuable for that ecosystem. So again, it will come down to how the market evolves, but as a team, a lot of it will come down to your own expertise, your focus areas, and really, frankly, how much runway you got when it comes to observing how the market's going to evolve.
Yeah, I think I'll add to that. So I think for AR, we hear a lot too, for mobile AR, that this is just, we're doing this ahead of the wearables. And I think that that's tricky because we have to have some signal that that's going to actually work when wearables come out, and who knows how many we sell, and if, Magic Leap has to go enterprise. I know I'm not just supporting enterprise by any means. I think there's going to be a huge consumer market, but I think for the price point, it'll be interesting to see if they don't take on more enterprise work or of a focus. But that being said, I think understanding what the founders are willing to do to test these ideas ahead of sort of launches, and then if that doesn't work, what sort of their not plan B, but knowing that they've thought about it more than sort of they came up with this idea and they think it's going to be great. And I think that sounds very basic, but you'd be surprised. There's not when you ask, get to the third why or whatever, then people don't have answers. And I think that it just needs to be a little more thought through, so that it's reducing the risk on our side.
Following up on that, what in an investor presentation would be a big red flag for you? 12 minutes for Q&A.
I actually look at the interaction of the team, the founders, and that's really important to me. I want to make sure, to the extent that I can, that they're going to be able to work together. And because this is, as you guys know, and anyone that's been an entrepreneur knows, it's really hard, and it's going to take some time and some energy. So I like to look at the inner dynamics of the team.
Just to add to that, I've been seeing a lot of pitch decks that combine AR, VR with blockchain, right? And it's interesting. Eventually a lot of these technologies, in my opinion, will converge, but it is super early in both those sectors. So when you go to an investor and say, hey, I'm going to tackle both these sectors, that's a huge red flag, from my opinion. Pick a battle and then go figure that problem out before you start to layer on other technologies that are coming to market. But I would say that would be one for me.
Just to add on that, I guess maybe one thing is maybe you need to have enough runway to get the enough funding for the additional investors. Let's say if you have only 1 week or 2 weeks of the runway, it's not gonna be enough time to get additional funding from other new investors. So just make sure that you have enough runway to get through the financing process. And the other thing is, sorry, I was gonna say something, but I forgot about it.
No worries. To follow up on that, what would be an acceptable burn rate? Does that differ wildly between VR, AR, MR, really the type of business?
Differs wildly.
Okay.
I would just say I don't think it really comes down to the stage of the business. I personally like to focus on how much runway you have rather than the burn rate itself. I think there are different variables and levers you can pull as an entrepreneur to figure out what exact burn rate you could sustain over time. But I would say 18-month runway is pretty standard when you look at different areas in the AR space and also in general in technology, I would say.
I mean, it's almost as if in each of our heads there's a poorly put together Excel model weighing all of the risks, and then it produces some sort of output called yes invest or no invest. And on the runway side, listen, you could theoretically as an investor tolerate a faster burn rate, but if you were going to take on greater risk in that dimension, then the expectation would be that something has got to give elsewhere. So you might take a faster burn rate from a repeat founder who's demonstrated an ability to do it before. You might take it from a product in a space where the use case has already been validated, or at least the underlying adoption rate had been validated. So it's conditional. But you have to basically ask yourself, always, if I'm going to ask for greater give here from a VC in terms of risk tolerance across one dimension, where am I compensating for it elsewhere? Because if the answer is nowhere, then you're just basically saying, I'm presenting myself as a really risky bet, please give me money, and those conversations usually don't end well.
Yeah, and I think with the numbers from Q1 of this year are just similar than that they've been for the last year, which is that the time between seed and Series A is getting longer. It's about 1.5 years now. And then the time in later stage is getting longer as well. I think it's about 2 years. And so, I mean, if you just take that, you need at least 1.5 years in early stage.
And to turn to a more sort of positive note is what sort of metrics would be very appealing to you as an investor? I know you've been, dev signups was mentioned. What else would be interesting for you that startups should emphasize?
So I'm always really interested in the amount of repeat use. I was trying an application recently, and I sent it to my niece and nephew, and they tried it, and then now I get one at least every day for the past 8 days. So obviously they're addicted, they're going back, they think it's cool, they're trying it on other things. And so I look for that kind of those obsessive users.
When we look at where the money's coming from, I'm wondering if there are any thoughts from you all about areas that you might not normally think of that are geographically, or certain accelerators that XR startups should really be looking at that might not be on their radar.
I mean, I can talk from a Canadian perspective, I guess. There's a ton of government funding available, I would say, in Canada at least, and the government's done a great job providing tax credits to folks in VR and AR as well. There are actually 2 types. One, if you're in content creation, you can get film tax credits as an example if you're producing VR content, and obviously there's tax credits on the engineering side. So depending upon obviously what type of business you're building, there's certainly that type of funding available. Yes, it's not direct cash or money in your bank, but you get money back as an example. Accelerators perspective, there's obviously a lot of them. It really comes down to what segment you're focusing in. I like accelerators that have very specific thesis, either call it enterprise or a specific segment in VR or AR. I prefer working with them just because they have a clear strategy. And other than that, there are obviously a lot of other pre-seed funds and angel networks that have financing opportunities as well.
So I think maybe the last couple of years, because there's been a little bit of a bubble, it's been easier. Some companies were able to raise more money early with less, which was advantageous to them because they could kind of build up coffers and survive. And I want to, as that happens and some air deflates from the balloon, it's hard to look at previous examples, match up against them, and get the same results. You might say, company X that raised last year was able to do this. Why am I unable to do the same? And if the standards, especially as we're kind of ebbed, for example, in VR, are more stringent, I would say I would strongly consider, to the best of your ability, not actually raising venture money at all in the beginning. I think that again, we talked about tropes. People are essentially always trying to recreate what they've seen done before. But the reality is once you take that money, the clock starts ticking, and it comes with certain expectations and realities. And the question I would ask myself is, are there other ways to do this? Not to say you should never take that money, but can you validate your product before taking that money? Can you do this on the side while holding another job? Do you have savings that you could use temporarily? There are other ways to do this. I mean, I hope I'm not being self-defeating as someone in venture telling you, but I think it's just practical advice. And so I would just be understand exactly, one really good example is I think looking to government funding or grant-based funding, and then another, if you couldn't get that, is sometimes it just isn't worth raising at all. And that's a tough reality to stomach, but can actually save companies that might struggle as venture-backed early on, but might actually be able to grow and validate to a point where they could be venture-backed later on.
Just to add to that, I've seen some companies do a pretty good job at funding initially through customers. So I think we talked a little bit about services type of contracts. That helps, but with that comes a challenge. How do you eventually move into more of a, what venture backable companies may do when it comes to business model? But I've seen a lot of successful startups actually fund themselves through customer contracts, which have worked really well for them because they've been able to validate customer requirements, get paid for it, build a product, and then after that, once they have a platform or a product built, then they've gone out and raised venture financing.
And after funding, there's a question of, when are we going to see more exits in the space? We have, I think, investor interest is really supercharged with the, around $2 billion acquisition of Oculus by Facebook. We haven't seen anything, nearly at that level since. We saw around $100 million exit from 3D imaging startup Outward, which Williams-Sonoma bought last year, but we haven't really seen anything, in the billion range. I'm wondering if there's, when you think we might see more exits, both either for VR, AR, MR, and what form that might take, whether acquisition, IPO.
I think it's too early to tell. I wonder what Magic Leap is doing with all that money. So perhaps they will buy some startups and core fundamental technologies that they would eventually need. But I think it's too early, right? I think my view would be, yes, we'll probably see some level of M&A activity, which would be the initial step as the ecosystem and the market is built. Once there's sufficient distribution and companies and market cap around that, then you can potentially see, large businesses going IPO. But I think a lot of the initial exit activity will be focused on M&A and will be largely focused on companies that are existing incumbents that will be purchasing specific parts of product roadmaps that they may have a gap in, or they're looking for specific technologies that accelerate their either the product or platform side of things.
All right, I'd like to get to Q&A pretty soon. Oh, go ahead. Go for it.
Oh. I just wanted to answer like a little bit differently. So as a founder, you have to be like really prepared for like worst scenario, and it's gonna take this like a VR AR industry. It's gonna take some time to get to like some sort of like exit or maybe like meaningful revenues. So we have to be maybe like find the right partners, like a right investor to work with, so that sometimes the company, the investor has like a deeper pocket, and also there are some funds like us who are really committed to invest in the VR industries. So that's like, for example, we keep actually like 1/3 or like 1/2 of the our fund to do the follow-on, even though our fund is kind of small fund. It's like a 20 million fund. So just look for those right partners to work with, so that you can survive all the long winter of this entire industry.
So I'm not going to comment on Samsung's M&A strategy, but I will say that for some of the types of players that have been suggested may play a role in like the consolidation in the space. Two things to note. So someone who works on our M&A team, I was just having a conversation with her name is Christiana, and she noted that one thing she noticed when she meets a lot of founders is that people don't actually appreciate how few companies really get acquired. And so it's interesting that it's always mentioned like top of breadth as an exit opportunity, but it's actually a very low probability outcome, and it's important to set expectations on that. And then number two, like I think for companies that do get acquired, there's false expectations set about like how that process works. And I would say that like if you want to improve your odds of getting acquired, then you just basically, you can't assume that companies will take note of you. And so the question is, how do you put yourself proactively on the radar of folks that you think should take an interest in you? And so it goes beyond just building a relationship and talking to folks at a conference, but you need to ask yourself, how can you demonstrate value to that company now? Because I'm willing to bet that far more companies get acquired that have already done some sort of proof of concept or engaged in some sort of existing partnership than just done ex nihilo out of nothing because they read like a VentureBeat article about this, the company. So figure out how to get top of radar within the companies before, I think, even entertaining the possibility of being acquired.
This is just one more note on the sources of funding. I mean, crowdfunding is still a thing. I mean, but that being said, I think it's 1% of companies actually get money. So being realistic on like your opportunity there, but it is an option.
All right, on that note, I think we should open it up to you all. So any questions?
Let's start right here.
Great panel. I have two questions.
One is to Abby on how you started Women XR Fund. Arlen Hamilton is someone that I really look up to, and so many people have come to me saying, you're in tech now, but you had a prior background in political fundraising. How are you doing that? And then my second question, is just broadly to the panel, is how much traction is enough traction to be fundable? So specifically, and I would ask Amy and Abby this as well, as do women overcompensate? For example, I was talking with Maddie Callender, who's our colleague at Boost, and she said, well, maybe you're overcompensating because you don't think you have enough traction, but you actually do. And I would talk to YC founders. The space I'm working in is biotech, AR, VR, and AI. And she said, well, you need 3 letters of intent for demo day. I said, I wanted that before I even applied for seed funding. So what are the level of expectations that are either realistic or unrealistic? How are we measuring traction? And is that like how much monthly revenue of funds a startup is making, whether it's enterprise, that's the space I'm in. It's a very long sales cycle, and raising money is not easy. So that's my question, is just how did you start to fund? And then 2, broadly, like how are you measuring traction? Because I think a lot of the people that I see tending to raise funds in the B2C space is like, I made a game and I have like 100 users a month and I'm gonna charge them $100 a month, and look, I'm making so much money. And I'm just like, that's not, like I'm dealing with an entirely different market, which is highly regulated. And so I would like to just hear advice on how you build a fund and how are you measuring traction given all the different verticals that you all have experience in.
Sure. So thanks for your question. And so we started the WXR Fund. I'm one of 3 co-founders, Martina Welkoff and Malia Probst with VR Scout, if you're familiar with her. We started this last year, it's a little over a year old, because we all saw the opportunity. We saw a lot of women founders couldn't get funding. We'd all been in the AR and VR space for a while. I was at Daiquiri before, I was at Mucker for over 3 years. And I think that we thought we would prove that there were more companies than we're even seeing. And so that's what we set out to do first. And we started our accelerator. We just, on January 6th, had 8 startups out of 70. I think we had 76 apply with just no marketing. I mean, 3 weeks of social media push, and we had 76 companies apply with at least 1 woman founder or heavily women-led, which is a loose term, sort of. And so there were a lot more companies than I think most people assumed that there would be. And then we just had our second application for our second cohort, and we had almost 100 applications. And so part of this was us proving that this was real, that there were more companies out there than, because a lot of people said, well, there probably aren't many, right? And then of those, how strong are they? And of our first 8, I think 4 have received funding subsequent to our first pitch event on January 6th. And our second pitch event is happening here on Friday, shameless plug, in this exact stage. Our 8 finalists will be pitching to 6 VCs. And anyway, so it was really just born out of a passion / just need that there needs to be some more support to keep women in the industry. And then fundraising is just a whole separate process, and it's very fun. Lots and lots of conversations with LPs. And so that was your first question. I'm going to let Amy answer the second part, and then I'm going to come back when I think about it.
What was the second part again?
How do you measure traction if it's like, how much revenue are you generating per month for like enterprise? Like if it isn't consulting, like what's your like threshold or measure? And that's very different. B2B is so different than B2C. So.
Yeah, and also, I'm an angel investor, so I'm investing super early, which means there's no traction or like very little traction there. But obviously, I work with the companies, and I've mentored a lot of companies to set goals and looking at what are reasonable goals in terms of traction, because you need to focus and have a direction and move that particular way. But from an accelerator perspective, because you were talking about getting into accelerators, there are accelerators of multiple different sizes and multiple different qualifications. So from that perspective, I would really encourage anybody that's doing an accelerator to just reach out to find out what the requirements are, and also talk to somebody that's been through that accelerator. That's a really good learning process. There are some fantastic accelerators out there in the VR AR space, and so for first-time founders, for sure, I would consider that.
Thank you. So we don't look at a specific MRR or ARR because it just depends on the industry and the stage and how long you've been going and how much prior funding and all of that. But I think that one thing that I've definitely noticed is that a lot of investors that we'll talk to, and you press them on why they didn't do a deal, I think a lot of it comes down to they don't understand the space that you're going after. I mean, there's so many medical applications and HR applications and training where nobody knows the sales cycle. Well, I shouldn't say nobody, but the people that I've been talking to don't know the sales cycle, don't know who you're selling into, who's actually the check signer. And I think that they then just turn it down. And I think that if there were more education brought on by the entrepreneur of like, here's how I'm selling, here's how long it's taking me, here's who I'm going after, I know they have this amount of budget, and really have the numbers prepared for the investors. I know it's kind of doing their job for them, but I do think that because there's so many different applications of this technology that are more broad than a lot of investors typically look at, that is very helpful.
All right, next question.
So earlier it came up that tools are bad, core tech is good. How do you differentiate between the two, and how do you distinguish them when a company comes and pitches you?
I'm going to have to check the tape on that one. I'm not sure if that's what I said, but taking your word for it. So this ultimately comes down to, so first off, I think the core principle that's operating here is one of how rigidly defensible is the thing. Like anything that is used to make another thing happen could be like by definition a tool. I think when people use the term tool, at least I'm surmise on this panel, I think what people are referring to is tools that facilitate content creation by and large. And so that depends. I think the other assumption here is more an interface, whereas I think core tech would go beyond that, and core tech could lay in the hardware domain. So are you building a physical piece of hardware that enables the experience? Are you building a piece of software or an algorithm that enables the experience? Do you own a data layer that is essential for the facilitation of the experience? And so to make this concrete, I would define core tech as being like, do you own chips or sensors? I would define core tech as being like, do you have a highly specialized or refined algorithm for SLAM or hand tracking or something like that? Or core tech might be defined as, do you own like AR cloud data, for example? Do you own all location data that you would need to ensure persistent multiplayer and contextually consistent experiences? That's not an exhaustive list, but just to illustrate the point, that's a difference. And to kind of get above the question, so why do we care about those distinctions? You care about those distinctions because at the end of the day, there is a belief, and often a fallacious belief, that if your competitive advantage is grounded in hard tech, that is more defensible than other competitive advantages. I don't necessarily subscribe to that. Technology can be stolen. Technology can be replicated. It's very difficult to litigate patented technology. And even if you have an advantage that's based on interface and ease of use, if you develop a strong enough brand and strong enough developer community, those moats can be equally powerful. So I think oftentimes implicit in the distinction is some sort of argument of the superiority of one versus the other, and that was at least not my intention, having not checked the tape. So in sum, tools good, core tech good. Thank you very much.
I think we probably have time for one last rapid fire one.
Nice panel, thank you. Are there major themes you aren't seeing that you'd like to see?
Are there major themes? I think that, yeah, I'd actually like to come back to content for a second. So I notice that when a lot of people create so like I actually get it, like content is a creative pursuit, and it's a lot of the folks I've encountered that have created like best-selling or well-reviewed content, like did it almost a lot of the time because like a vision popped in their head to go and do it. and there wasn't necessarily like a top-down rhyme or reason. So from a VC perspective, that's hard to spot. Because like at the end of the day, if someone's like, I'm going to create an AR game about a mouse that rides a pogo stick and then fights knights with it, and you're like, that sounds stupid, and then a year later, it's like generated $1 billion. Like, who knows? Like, I couldn't necessarily have predicted that. There was no rhyme or reason, but yet that could take off. On the flip side, I do think that I wish I saw more top-down argumentation for why a piece of content will prove successful. And I'll give you an example on a theme. So I really do like to go to first principles for AR, and particularly mobile AR. So for example, if you were to ask me if I thought like certain pieces of content might take off or certain applications might take off next year, I would argue that I think that content that I'll work back from it. I think like a personal pet application might be kind of interesting, and I'll tell you why. Because I think that for two reasons. One, I think a lot of kids grow up without a lot of space, and they can't necessarily take care of a pet. And two, I think that built into that use case is the opportunity to share with your friends interesting content that captures how you're playing with the pet. Now that might seem like a really weird or niche example, but the theme that I'm trying to work off of here is like what actually might substantiate a good bet in content. I might say like it plays towards your emotion. I might say that built into the format is the ability to share and self-market it. And I wish I saw more content that was conceived across a framework like that, because at least it makes a VC's job easier. Otherwise, you have to go off of other things, and it's really unpredictable. So I know it's not like theme, like I'm not sure if you're asking for vertical, but that's definitely like on my wish list of things that would make my life easier.
All right, I think that is time. Thank you all, and thank you to the panelists.